Hey everybody, Rob Maurer here, and today we're going to continue to talk about Tesla earnings. There are some things that I need to say to people. I think people need to understand a few of these things. Normally we'd go through analyst reaction, things like that. No time for that today. I've got my own analysis that we're going to talk about because the market really just doesn't seem to understand it. So we're going to try to help as much as we can today with that understanding. Probably a fruitless process, but we'll do our best. Anyway, Tesla today, after reporting earnings, down 11.5%, closing at $829.10. I don't want to be flippant. Sometimes I just can't help myself. Probably one of the dumbest reactions I've ever seen. Now, the macro wasn't great today. The Nasdaq did close down 1.4%. Growth stocks faring a little bit worse, but certainly not the worst day that we've had so far this year. So let's take a look at just a couple of the many reasons why I feel like Tesla is underpriced and this reaction is incorrect. And feel free to send this over to your friends that remain skeptical of Tesla, because we're not going to be talking about FSD or the Tesla bot or anything that lies in Tesla's future. We're just going to be looking at some of the concrete numbers of Tesla's business as it stands today. As we know, yesterday Tesla reported GAAP earnings per share of $2.05 for the fourth quarter. That put them at $4.90 for the year 2021. That happened to be up an ominous 666% year over year. Now that $4.90 of GAAP earnings, that works out perfectly because it gives us an exact comp to Amazon. We can go back and for the year 2016, Amazon also earned GAAP earnings per share for the year $4.90. You can see the earnings chart here from Macro Trends, and I did go and check this against Amazon's annual statement from 2016, and you can see their diluted earnings per share for 2016, $4.90. Now for Amazon at the time, that was really rapid growth. That was up 292% year over year. So really dramatic growth, but still not even close to how quickly Tesla has grown during a similar stage or period of time in their business. Now, what is also crazy is that if we look at Amazon's stock price at that time, so February 2017, that would have been right after they reported this annual report and that $4.90 per share. Amazon's stock price at that point in time, right around $830 per share, exactly where Tesla is at today. So both companies at those respective points in time, trading about 170 times trailing 12-month GAAP earnings. So, okay, maybe it seems like Tesla could be sort of fairly priced then if you ignore the fact that Tesla has grown much more quickly. Hey, maybe Amazon's growth projections were higher than what Tesla expects. So maybe in that case, it makes sense. Well, we have the benefit of hindsight here and we can see that no, that is not the case. And it's not even close. If we go forward 1 year, Amazon ended up earning in 2017, $6.15 per share. Now, if you don't know the history of Amazon, brace yourselves here because we're about to flip back to that share price chart. And we can see that in early 2018, after Amazon reported that $6.15 earnings number for 2017, Amazon was trading at above $1,400 per share. Tesla this year is absolutely going to post GAAP earnings per share above $6.15. The current analyst consensus is $8.04. That's less than Q4 annualized, even though Tesla is expecting to grow deliveries by more than 20% above the Q4 annualized rate, which will put deliveries for the year up by more than 50%. So Tesla, a company that is growing faster than Amazon, has grown faster than Amazon, and has a roadmap to continue growing faster than Amazon for quite some time, has an excellent chance of delivering earnings per share of about 50% more than the earnings per share Amazon was delivering when that stock was trading at $1,400 per share a few years ago. And yet, here we sit at $830 per share. And if you went back and you had bought Amazon during those periods of time, by the way, still a good investment at those levels. It was underpriced because it's outperformed the Nasdaq since that time. Now, to be fair, the market is forward-looking, so it is worth acknowledging what Amazon was able to accomplish then in 2018. They did $20 GAAP earnings per share. So that $1,400 stock price, that was just before a decent inflection point in their earnings power. But if we carry this analogy forward, that would comp to Tesla for 2023, and Tesla's going to be at an inflection point too, with Austin and Berlin likely both hitting volume production to head into 2023 and carry earnings throughout the year. So I don't see that as a good counter-argument. Plus, whether you believe in autonomy or not, Tesla is going to start earning more money from FSD, even if it's not perfect, and that'll create an even more dramatic inflection point than what we saw in Amazon for Tesla's earnings power. Now, obviously, the macro environment was pretty favorable for Amazon through that period of time. We don't know what's going to happen there for Tesla. There's no guarantees Tesla stock acts the same and shoots up to $1,400 per share. That'd be pretty tough to do if the market drops another 10 or 20% or so, regardless of Tesla's strength. For long-term Tesla investors, though, as long as Tesla can continue to execute on this very clear path that they are on, it'll happen eventually. The multiple can really only compress so far before every single quarter you're seeing a 15% increase in the stock price, which the market, being forward-looking, is just not going to let happen. So when the market decides it's ready to fully reflect this future, that's anybody's guess. As we have seen in the past with Tesla, that can happen very suddenly after very long periods of time of not recognizing that. And to me, it definitely feels like we are now in one of those periods of time. Maybe that lasts a few days, a week, a couple of years, who knows? But those periods of time are great opportunities for accumulation. All right, personally, I find that comparison pretty compelling, but if you're still not convinced, let's take a closer look at some of the things in Tesla's Q4 report, because as we further our understanding of some of these items, it actually shows that that comparison that we just made is even understated for Tesla. So the first thing I want to talk about here is CEO compensation. I know I mentioned this a couple times yesterday, but this will be much clearer. Back in 2018, Elon was granted a performance award based on hitting certain market caps and 12 out of 16 operational milestones, and 12 of those are now considered probable of achievement. So that means that almost the entirety of this performance award has now been recognized. In total, it's about $2.2 billion in stock-based compensation, but $910 million of that was recognized in 2021. That was the most of any year so far. As you can see from the chart here, there's only $65 million left for this plan to be expensed in 2022. So for 2021, it was an outsized impact on Tesla's GAAP earnings. If that 2021 hit had been the same as 2022's will be, then Tesla would have earned $5.64 per share rather than $4.90. I think stacking this chart up shows just how insignificant that's going to be for this year. I couldn't even fit the label at the same font size as the other years. So in short, this is a huge positive tailwind for Tesla's financials in 2022. And yes, there may eventually be another CEO compensation plan, but if there is, I would expect that to be tied to market cap milestones, just like this last CEO compensation plan was. So if there are future costs that then eventually come back into the financials, that would only be as a result of a very significantly increased stock price, just like what we have seen with this plan. Now, one counterargument to this would be that, oh, Rob, you shouldn't even look at that. That's stock-based compensation. That's not included in non-GAAP earnings per share anyway. And while that is true, the price to earnings that you're going to see on Google Finance, Yahoo Finance, wherever, that's going to be in GAAP earnings per share. And even if you don't care about that, stock-based compensation, which this falls into, is included in selling general and administration costs, which is included in Tesla's operating expenses. If the CEO comp for 2021 matched what it will be for 2022, Tesla's operating income would have increased by 13%, and their operating margin would have gone from 12% to 14% for the year. That's a huge difference for a non-recurring item, so it's very important to understand. Now, the other huge factor that is also non-recurring, at least for a while, is the $340 million payroll tax on the exercise of the 2012 CEO Performance Award, so that 22 million shares that Elon exercised in November and December. Now, this also falls into selling general and administrative costs, so also impacts Tesla's operating expenses and therefore operating income, but this is not stock-based compensation, so this also impacts Tesla's non-GAAP earnings per share. These two non-recurring items, CEO comp and then the payroll tax, are significantly hiding the strength of Tesla's Q4 report. To make that clear, I've put together a little table here, only adjusting for those two numbers, so taking out the $340 million payroll tax and then reducing CEO compensation from the $245 million that it was for Q4 down to about $16.25 million, which is what it should be on average per quarter in 2022. As I mentioned, both of those hit SG&A, so removing those, that drops SG&A expenses by 38%. That drops operating expenses by 25%, increases operating income by 22%, operating margin for the quarter up to 18.0%, 320 basis points higher. EBITDA is up, net income is up, and looking at earnings per share, on a non-GAAP basis, that increases by 30 cents from the payroll tax. That's up then to $2.84 per share, and then both of these hit GAAP earnings per share, so that would increase all the way up to $2.55. That number, $2.55 per share, that is a much more accurate reflection of what Tesla is able to earn on the scale of their business from the fourth quarter. That annualizes to $10.20. Right now at $830 per share, Tesla would be trading at 81 times earnings. And again, that's Q4 scale. That's 308,000 vehicles delivered. Tesla on this conference call just told us that Shanghai and Fremont by themselves this year should be able to grow the business 50%. So that's about 1.5 million vehicles per year or 375,000 per quarter, at least 22% more output than what we saw from them in Q4. If you increase deliveries by 22%, you're probably going to grow earnings by at least 30%. So you're probably looking at $13 to $15 in earnings per share on a GAAP basis from Shanghai and Fremont alone at the scale they'll be at in just a few months. That's more of like a 55 to 65 price to earnings. Are we getting it yet? Are we understanding how ridiculous this is starting to be? I'm not doing any crazy ridiculous math here. All I have done is remove two items that are non-recurring, applied the growth from Tesla's own guidance, and then annualized it. That's it. Yeah, maybe ramp up costs from Texas and Berlin, suppress that for some short period of time, but who cares? After that period of time, then you just get to do all this same math for those factories. 2 factories, which by the way, are going to be bigger, newer, and increase Tesla's localization. They're going to actually be on 3 continents now instead of 2. To go back to my opening comments, this is dumb. It's really, really dumb for real. Now, I can already hear some of you arguing, well, Rob, you didn't factor out regulatory credits. Yeah, I didn't, because those have been recurring. They also become less impactful every single quarter. And what I didn't take out on the expense side was about $350 million of Q4 expedite costs. So if you want to take out regulatory credits, that's fine. Just take out the expedite costs. And then there was also like $66 million of other income, maybe foreign exchange or something. So take those all out. Those kind of all wash out and we get back to the same numbers anyway. So I think Tesla is very clearly underpriced right now. How long it'll stay that way, again, who knows? Could be a long time, could be not long at all. I think the market's just overreacting right now to some of the comments on the call about the Cybertruck being a little bit later, the $25,000 model not really being on the drawing board right now, though I think that's being misinterpreted as well and definitely misunderstood because both of those things are only happening because Tesla feels like they can sell so many more of these more expensive vehicles that they're already making. Elon confirming that in a reply to an Emmett Peppers tweet today, saying exactly to Emmett basically making that same point. That's going to be way more profitable for Tesla, and I think if Zach Kirkhorn had been the one to express this, the market probably would have reacted positively. Wall Street doesn't want to hear Elon talk anymore about FSD or the Tesla bot while delaying other products. Now, that's not a criticism of Elon, that's a criticism of Wall Street for a sort of weird mix of short-sightedness, but then also a lack of understanding of this being a positive for the short term. So anyway, I'm happy with earnings. Let's move on. Right, even though we do have that confirmation of a delay for the Cybertruck, we do have some new photos of it from Joe Rogan. He was able to see the vehicle at Giga Texas, posted about 5 photos of it. Good to see some more shots of the current version, and this time in not a fluorescently lit room. So I think it looks really nice in this backdrop with Giga Texas there, and we get to see a couple new angles as well. The other item I wanted to discuss, this was pre-earnings, so just catching up on it here, but Moody's has upgraded Tesla's corporate debt rating from BA3 now to BA1. So looking at this chart of their ratings, BA1 is 1 notch out of investment grade rating. So currently not investment grade rated by Moody's, but 1 more upgrade will get Tesla there, which, as we've talked about, some investment offices filter on that, so should unlock some new investors if and when that does happen. I had to kind of chuckle at a part of this because this was released just 2 days before earnings, and one of the lines in here reads, quote, Moody's expects free cash flow to increase considerably in 2022 from an estimated $3.1 billion for 2021, end quote. Well, just 2 days later, Tesla ended up reporting $5 billion for 2021 in free cash flow. So, just about 60% higher than they had estimated 2 days ago. As for factors that could lead to Moody's upgrading their rating, they say, quote, the ratings could be upgraded if Tesla successfully expands its global footprint, maintains a strong competitive global presence as other automakers offer an increased number of battery electric models, and improves its product breadth. Tesla's ability to sustain an EBITDA margin of at least 7%, measured excluding the contribution from emission credits, and a consistent prudent financial policy are also important considerations for higher ratings. Further, Tesla will need to maintain very good liquidity, including ample cash and considerable committed availability under its revolving credit facility, end quote. Fun fact, Tesla's EBITDA margin excluding regulatory credits was 19% for 2021. Looks like Moody's there is saying EBITDA though, so not excluding depreciation. Without the 10K, we don't have that broken out yet, but that should put the EBITDA margin around 15%. So either way, I think they should be good staying above 7%. All right, last thing for today then, just a quick note, Tesla Daily as a channel has hit 200,000 subscribers on YouTube. So just want to say a huge thank you to all of you, and especially thank you to our editor, Jasem, who helps make all these videos more interesting and informative for all of you. If you haven't subscribed yet, what are you doing? You missed your chance to be in the first 200,000, but there's still time to make it in the first 300,000, so do that today. But as always, thank you all for listening. Make sure you're signed up for notifications as well as being subscribed. You can also find me on Twitter @Tesla Podcast, and we'll see you tomorrow for the Friday, January 28th episode of Tesla Daily. Thank you.